I remember we looked at this one deal and it had its own sewage plant on it.
Yes. In North Carolina.
They literally processed their own sewage. How's it going, guys? And welcome to episode 5 of How to Invest in Commercial Real Estate. My name is Braden from the Criterion Fund. I'm joined by my partner, Brian Duck, also co-founder in the Criterion Fund, and Joel with Precision Equity.
What's up, guys?
What's up, man?
Braden.
How you guys been?
Pretty good.
Good.
Got some snow over the weekend. It's cold where we're at the time of recording. But anyway, the episode today is all about how to invest in commercial real estate and the different asset classes that people are investing in. So when somebody's investing in commercial real estate, they typically have, the top 4 or 5 asset classes in mind. Industrial properties, so those can be, single tenant. Those can be a lot of things. Warehouse space, ideally. Multifamily, which is basically apartments. You have retail strip centers, which businesses lease out, like Target, GameStop, restaurants, et cetera. Raw land. You have hotels and
Office,
hospitality, and then office. Yep. So we're just going to hop right in. I think the first one is industrial. So hop on over to the slide we made. You can see there's a few different pictures of what an industrial investment could look like. So let's just hop right in. Joel, what are some pros and cons of industrial? And then, comparatively speaking to maybe some other asset classes, how do they trade?
Well, I'm obviously not an expert on industrial. We've looked at a lot of industrial deals over the years, but we've never purchased those. But I do know that a lot of people like them and buy them. Previous employer Stan Johnson I worked at, they sell a lot of single tenant industrial deals like FedEx facilities and warehouse. I'd say
like a distribution center.
Yeah, distribution centers, and really
manufacturing facilities.
Industrial has become a little bit of a hot area of commercial real estate. A lot driving in our market and in Colorado and others is marijuana indoor grow facilities.
Yeah,
they've been sucking up all of the vacant industrial space. But just by nature, industrial tends to be more single tenant because it's a lot harder to divide. Usually, it's bigger spaces with high ceilings. Warehouse,
super specialized for the user. Typically.
Yeah, you may have heavy lifting cranes. So it's manufacturing warehouses, it's distribution centers, storage facilities. Self-storage is kind of under the umbrella. Comparing it typically is a lower price per foot. Obviously, it's a lower rent per foot than retail and office and a couple of the others. But I would say the returns are. The cap rates are a little higher than multifamily and retail. I don't know. There's probably some lower if you get a credit tenant for a long time. Like if you get FedEx on the hook for 10 years, it may be a 6 cap. But if it's just a local manufacturing shop or warehouse, it's going to be on the higher side.
Can it be riskier because being single tenant that you buy a manufacturing facility or something and you lose that lease, or so does it have more risk factor than maybe some of the other retail where you've got multiple tenants?
I think single tenant always has that inherent risk of losing the one single tenant. But I think what goes hand in hand with that is they typically have longer lease terms to make up for that. So you're getting 10, 15, 20 plus year lease if it's a single tenant deal. Mm-hmm. And then a lot of single tenant deals are full triple net, meaning they insure the building themselves, they pay the real estate taxes directly, they're taking care of any common area maintenance, and that could be a benefit to industrial as well. Just because it's super easy to own. You may not even need a management company.
Yeah, the risk profile for industrial is way more focused on the credit of the tenant versus multi-tenant retail or multifamily or an office that has a bunch of different users in it. So really, if you're going to get into industrial, you're either going to try to get it at a low price point, maybe vacant, and try to lease it, or you'll want to really analyze the credit. If it's a single tenant industrial.
Yeah, I mean, there's a lot of different types of industrial. I mean, I don't think people are buying industrial properties based on location necessarily. It doesn't have to be in a busy thoroughfare with tons of traffic counts. It's not necessarily focused on the consumer. It's maybe not the sexiest building you've ever seen. Typically got high bays, garage doors. And I mean, it can be anywhere from you're leasing 1,000 square feet of bulk warehouse space for $8 a year, or you could be Amazon,
Hundreds of
leasing
thousands of
millions
square feet. Yeah.
I mean, Amazon is leasing millions and millions and millions of square footage that they don't own. So it can be super specialized for you, or it can just be general, warehouse space for, an AC service company, and they just need 2,000 square foot shop and a receptionist. That's perfect for them.
Yeah, definitely location is not the main factor. Credit or the price point you're getting at is.
All right, so the next one we have is multifamily. This is a good one for us. Joel's done a lot of multifamily deals, done it for a long time. Why do you do multifamily? Why do you love it? Why does everyone else love it? Walk us through it.
Yeah, so we started with flipping houses. I think we've covered that. And we just wanted to get into bigger deals. And that was something, we originally looked for. Hey, we've done several houses. Now we're going to look for an 8-plex or a 10-plex. That was my thinking. And in looking for a 10-plex, we ended up finding a 48 unit. That was our first one. So it was just kind of a progression from single family to multifamily. I didn't really understand, or I really wasn't aware of how the other asset classes worked at that time. That was something we learned along the way.
So your business plan was to take this value add, house flip strategy and do it on an 8 or a 10-plex and just do
Initially,
8 or 10 at a time. Let's improve them. We'll get higher rents and then we'll sell it because it makes more money.
That's right. That was our plan at first.
And like industrial, are there different types of multifamily? I mean, there's high-rise apartments in bigger cities.
Sure. Unfortunately, I didn't have any money or experience when I started, so I was looking at older, rundown multifamily because that's all I felt like I could afford.
So like a Class C or a Class D.
Yeah, they were tough assets that people were wanting to get rid of. If I had it to do over again, I may have taken a different path. But yeah, we cut our teeth on some of the tougher area, tougher location. Maybe rough around the outside. We picked it up at a low price point, and at the time, I thought that was the only way I can get into that side of the business.
Yeah. So I mean, why do investors love multifamily? Like, what is the most obvious inherent thing about multifamily? It's a living space, right?
Yeah, I think a part of the attraction for investors is the fact that people got to live somewhere, right?
Right.
So as opposed to retail or a lot of these other asset classes, whether people are losing their jobs or whatever may happen,
it's the first bill they're going to pay.
Right.
It's the first bill they're going to pay is their apartment bill, because they don't want to have to move. Going back to your question, they do come in all different types. You've got A class would be brand new multifamily in a really good market,
like that
location.
red and glass one up on the presentation. That's a really good custom A class apartment deal that you might see in Dallas, Fort Worth, or Southern California, or something like that.
Yeah, and so A class, you'll either get brand new stuff is called A class, or really well located stuff that may not be brand new that's still A class. It's in downtown Dallas or something. It may be A class multifamily. Right. And then your B class, typically it follows age. So you get an apartment complex that's 10, 15, 20 years old.
So it was an A class, but it's just little age on it.
That's right, and it's out of date. It's not the fresh new place maybe that people are moving into. So the rents are a little lower, and they typically are not high rise. They're cheaper builds. They're garden style. When someone says garden style, it's usually 2 to 3 story suburban type multifamily units that you see driving around your neighborhoods.
Yeah,
that would be a typical B class.
Could you have a B class that is fairly new construction, but it's in a less desirable location, maybe, or is that because it's fairly new construction that automatically makes it A rather than B?
Yeah, you might. These are not hard and fast.
They're not hard and fast rules.
Rules with these. So someone may say, "Hey, it's a B plus asset because it's fairly new, but it's not in a great location." Yeah, sure.
Okay.
Less masonry or a cheaper build or something like that. I can understand that.
Yeah, and C class is something that we've done a lot of. That's where we've made a bunch of money because you kind of eliminate a lot of competition. In that not everybody plays in the C class space, especially the big time investors, private equity, international money. They're going for Class A stuff in a really good market. So by the time you get to C, which may be a 1960s, 70s build, they're typically in neighborhoods that are older, run down. The operators and owners aren't as good at what they do, and so that puts it in a kind of a C class type type deal. C-class doesn't mean it's not, you can't make money on it. You can make a lot of money buying it at the right price.
I think of C-class as workforce blue collar housing. You can go out and get pretty much any job and go get a C-class apartment, no problem. That's a C-class. A B is, I think you can probably build a brand new B-class, but I think a B is just a slight step up. It's less age, so it's maybe 80s or 90s, and it's not 60s and 70s build.
Mm-hmm.
So you mentioned that a lot of the big money goes after Class A apartment or multifamily. Does that mean the cap rates are a little more compressed because you've got big money paying maybe paying a little bit more money for that asset, and so it's a little harder to buy? And
yeah, we haven't done a show on cap rates, and I know we need to. But cap rate is just basically the yield or return simplified. We'll break it down later. And so, yeah, as someone pays more for a property that's making a certain amount of income, the yield goes down on your money. And so, yes, typically you get, I'll go ahead and describe primary markets. They are, entry-level markets like LA and San Francisco and New York, and they're well-established. They're really large, and everybody feels comfortable buying there. Well, there's a lot of money around the world chasing those deals, so the cap rates can get driven down. And right now, I think you're seeing 4 and 5 cap multifamily deals, maybe even less in some of those cities. And then as you move to what's called a secondary market, that may be Nashville, maybe Dallas,
Salt Lake, Atlanta, Denver.
Yeah. I would say where we are, Tulsa and Oklahoma City, they're kind of on the cusp of a tertiary market moving into a suburban. A million people, a person MSA is typically a cutoff for a secondary market. And then you have tertiary markets where just smaller towns, not major metropolitan areas. And so the cap rates are gonna change. Not only in LA, they're gonna change from a Class A deal to a Class C deal or even a D class multifamily. But they're gonna move across primary, secondary, and tertiary markets. So what we've seen over the last 10 years or so, as the multifamily market's been super hot, is people can't compete in LA, so you're getting some bigger buyers into Houston and Dallas, and then pretty soon those buyers can't compete in Dallas, and so now they're like, well, maybe I'll go to Oklahoma City, maybe I'll go to Tulsa, because they're one of 20 bidders on a 6 cap deal in Dallas, and now they can be one of maybe 7 or 8 bidders on a 7 cap deal or 6.5, 7 cap deal in Tulsa. And so that's what we've seen a lot of. And the last asset class or style of apartments is D class, and that is either the location is so bad that it's rough, it's maybe has a higher crime,
down units maybe,
and then you've got a large amount of vacancy and run down units that are not livable. And so I've purchased a bunch of D class units as well. And
a lot, actually.
And most people, they don't want the heavy lifting of going in a place like that. And with rundown units, the management isn't good, and the area is a little tougher. But we found that those areas are really needing better management. And so we just go in, and you have a bunch of, maybe you've heard the term slumlords. They're absentee owners. They're not taking care of their assets. They don't care about the tenants. And they don't fix anything, the leaks and everything. So no one really loves living there, but they have to live there because they don't have enough money to go to a better place. Where we go in and we just make the units ready, and we bring a management team in there, and we're attentive to the tenants, and we bring a community feel. Well, now it's easy to rent at a premium in that market because all the other C and D class units that don't have good management, they're coming over to our place. And so even though the perception of the area isn't good, if you can be the best in that area, you've got a shot to make money.
Yeah, interesting.
Yeah, and I like that play. I mean, what other people were avoiding, you saw dollar signs in. That's typically where you're going to make your money. Some piece of garbage that everyone else passed on, and you just dig it up enough. I remember we looked at this one deal, and it had its own sewage plant on it.
Yes. In North Carolina.
They literally processed their own sewage. And I still think we should have bought that deal.
Yeah, we almost did, but we ultimately didn't think we could get our head around that.
I can see there might be more money to be made in those, because like you said, I can't imagine a big company that's going in and buying. They don't want to do that heavy lifting. They just want to buy and operate and move on.
Yeah, so we spent a lot of time on multifamily, but that's a super popular asset class. Super popular. The next one is another one of my favorites. It's retail. Brian, walk us through retail a little bit. What encompasses retail when we say that's in the retail asset class?
Okay, retail could be a strip center, a strip shopping center. It could be a power center where you've got a really large shopping center with a lot of big, huge anchor tenants like Home Depot or someone like that.
Home Depot or Target, maybe in that one up there. It's got a Ross, a Hobby Lobby. I would consider those.
Yeah, Kohl's, Best Buy, Lowe's.
Yeah.
And then you almost kind of those centers are almost kind of developed around that draw, right? Like you get Target on the hook, you develop that, and then everyone else says, okay, well, I want to be next to a Target, or I want to be next to a Kohl's or a Best Buy or something.
There's some of these smaller companies that that's their business plan is, Target went there, so I want to be right next to Target, or Ulta went there, Lowe's went there, Home Depot went there. I want to be there.
Yeah, retail can also be, maybe grocery stores could be an anchor tenant. It used to be a lot more back in the day. There's a lot more online shopping now, so that's evolving retail. And that's a good point to kind of transition over to you, Joel, is the internet. The internet changed the game for retail because prior to that, you had to go somewhere to spend money. Mm-hmm. You had to go to a store to spend your money, and now people are spending all kinds of money, especially with coronavirus. People don't want to leave their house.
We were trending towards online spending, and it was impacting mainly big malls, outlet stores like JCPenney's or Sears. That kind of stuff was moving online. Coronavirus has really added pressure to all types of retail. And so, we need to be a little more careful when we're evaluating retail space because the long-term risk factor has increased some. Now, I don't think all retail is going away, and I think some retail is still here to stay, like haircuts or gyms, nail salons, things like that, even restaurants to some extent, although they're suffering now. People have to go there to get that service. And so I think there is still good retail out there. And the good news is if you know what you're doing, the cap rates on retail, because of the perceived risk, are increasing, and the debt level is staying low. So I still think there's a lot of cash on cash, to be made on retail, but you do need to really be careful on what you're buying.
I think a lot of people are nervous, not just because of coronavirus, but like you said, because of the internet. People just, I've found in some of our retail deals that people are just generally nervous. They think that Amazon and online shopping is going to take over.
Yeah, so when we evaluate a retail deal, you look at a few kind of macroeconomics around the area on a map. Like how many people live there, the population density, how many cars are driving by that building every day, because it's focused on consumers. So you need people to pull into that parking lot and spend money at those businesses so they succeed.
It's much more factor driven than in industrial or even multifamily. We didn't really talk about it, but multifamily, the location isn't as critical because they don't mind driving a few minutes home. The retail, though, like you say, is you have to have good visibility, and location is going to be number one, where industrial location is not the number one factor, but in retail it is the number one factor, at least one of the top factors. Traffic counts are going to be a huge thing. How many people are going to go by and see your business? Because part of having an office, or an office in a retail space or a store that you're selling things, is you want people to know you're there, and so you want that traffic count to be high. Household income on average, what do people make in the area? That means they have disposable income. You want to be there. Someone may want to open a gym, a higher priced gym, in a high affluent area, versus a 10 gym that wants $10 a month out of people. They want to charge 45. Well, you need high incomes for people to want to do that. Or if you're going to open a liquor store or whatever it is, you want to have people that have money near where you are. So those are some factors that you want to consider when purchasing retail.
Right. Yeah. I think retail is good, and I think there's still a lot of value to be juiced out of retail. I think people are scared of it, but I think if you focus on the brand of the tenants and how they're taking this new generation of retail, and then the location, and a lot of people live there, they make good money that live there, and it has good traffic counts, you can trust those things.
We're buying a 3-tenant retail deal right now in Memphis, And so it's just 3 tenants, but the traffic counts are off the chart. The demographics and the income are good. And it's a Planet Fitness, so it's $10-15 a month, cheap gym, and it was really well built out. We have a Family Dollar, which stayed open through the pandemic, so they don't really have that risk of shutdown, and they're low cost goods that people just want to run and grab. And then it had a single tenant drive-through restaurant, and so you have that drive-through, so they were able to stay open, and people on their way home don't have to go in; they can just roll around and get the food. So we feel like that's still going to be a safe bet for the foreseeable future. And when I got a cap rate premium on it, just given the market right now. So,
Good.
All right, let's move on to the next one. The next one we have is land, raw land. I think this is probably one of the most broad available, just because there's obviously so much land, and it can be anything from shovel ready, meaning it's got utilities in the ground, it's entitled the right way. You don't have to get any sort of special use permit or any sort of rezoning or anything like that. Or it could be a pasture, with cows grazing on it, 50 miles north of the path of development. And you just say, hey, in 20 years, all of this development, all of this housing, all of this stuff that follows housing, like jobs and retail and everything like that, will move up eventually. So I'm going to buy this piece of land, maybe in the way of that, and sell it later or whatever.
I would typically say that for beginners, land is probably not going to be a great asset class for you. Mainly because it's more speculative in nature. When you buy land, either you have the expertise and the money and the capital to develop something on it, and that's going to take a long time, year, 2, 3 years. And so you have to have a lot of capital in order to hold that and go through that whole process. Or you're betting on it increasing in value, and so you typically can't get great leverage on land. It's 50-60% generally. And so it's very capital intensive. It's high on speculation.
A lot of time.
A lot of time. So
raw land doesn't pay returns typically.
Right. We're trying to develop our first apartment deal, and we're a year and a half in, and it's hasn't paid me a dime, and it's just sucked my capital, and so obviously I'm in a position where I can handle that. But I would say most people want to look for strong cash flowing assets. So they get that income, that security comes from that income. Once they're secure and they've got a bunch of money coming in, then you can take some risks on some land deals, or like we're doing, cut your teeth on a new development deal and kind of learn the ropes as you go.
Yeah, Brian and I are working on a few land deals right now, and they're just not fun. I would say they really need to be a developer or be focused in development, kind of be able to do something with the land. But we bought a site in Columbine and had probably 6-8 months in entitlements. We're buying a site right now in DFW, and it's a similar thing. We had to get permission from a Kroger. We're partnering with a group down in Fort Worth. They had to get permission from a Kroger. We had to get rezoned, and all these things take months and months and months, and it's a lot of time, and it's hard.
Yeah.
All right.
What's next?
Next is hotels and hospitality, which let's try to stay towards your traditional hotels. Obviously, hospitality can include a resort, a water park, Disney World, whatever. But let's focus on hotels.
So hotels, I almost got I actually did invest in a couple hotel deals just as a small investor online on a crowdfunding site, and don't ask me how those are going. Because the pandemic really hurt those. But hotels, I think you need to time it right, and you need to allocate for the risk, because they move wildly with the market. So they're not only very location driven, but if the market suffers, most hotels will suffer in general. And so I was looking at hotel deals, and they were delivering higher returns, 9 cap, even 10 cap deals. And when you can leverage those, a ton of cash on cash. But if I would have purchased those, they would be severely hurting, because overnight the traffic just stopped.
Yeah. And tourism's almost gone right now.
Yeah, it's starting to trickle back, but if you're not capitalized for this kind of event, then it's going to take a lot of people out. So hotels, I'm sure, can be really good investments. I haven't done one yet. but they typically come with higher cap rates and higher returns for the volatility that they have.
Yeah, and I mean, a couple years ago, we're in an amazing economy, eighth, ninth year of a bull market or however long we were in it. People are traveling. People are taking those trips. They have that extra money. The economy's booming. That's when tourism is great, and that's when you want to be in hospitality.
If we didn't have the pandemic clouding my future judgment, the time to buy hotels would have been in 2009 or 10, right, when they're auctioned off from foreclosure. And then you would have been able to ride the wave for the last 10 years. Now I would say now would be a good time to buy hotels, except I don't know what the game's going to be like. And if people ever fully recover from the pandemic, and if they do, what's the risk that we have another one in 5-10 years? So,
yeah. And I think with that is when you go in with timing like this, when hospitality's down and you want to say, hey, I want to find a good deal in a good market on a great hotel because it's empty right now. The leverage you're going to get on that is a lot less than a good economy too, because it's not occupied and you've got more of a pipe dream and less of a stabilized asset. So you have to go in with a lot more cash, and you can really reap the rewards if you do it right. But in the beginning, you're not going to have that cash flow that you would as a more stable hotel.
Riskier, but higher return possibly right now.
Yeah. All right, switching over to office. When we talk about office, these are businesses with a high number of employees that they've got to have working for them. They need a desk, they need a place to sit, they're answering phones, they're working, whatever. And these businesses are leasing anywhere from a few thousand feet all the way up to hundreds of thousands of feet. It can be a dentist office, your local neighborhood dentist in his own little, small medical building, or it can be a skyscraper in New York City. But office, generally speaking, walk us through it.
Well, I haven't invested in office. I've looked at some. I would tend to like the smaller suburban medical office than I would, a high-rise office building in these times. I mean, office, the virtual working from home was already gaining steam before the pandemic. And now I know offices that still haven't opened back up.
And some say they aren't going to open back up.
Yeah,
They're just going to let their employees work from home from now on.
Yeah.
And so I just, there could be the right office deal, but for me, it's just seemed a little bit more speculative. And I know people that have made a ton of money on office. So it's just maybe I don't understand the risk reward game, but you're kind of hoping that your tenant, let's say you get a big office building, that your big tenant stays. And if they don't, it could be a while before you fill it. It's not as easy as a 1,200 square foot retail space on a really good high traffic corner where a lot of businesses could fit there. It's a very unique size of space. Let's say you have 20,000 square feet of office in this 100,000 square foot office building. You need to lease that. You may rent that quick, and it may take you a few years. I've seen some sit vacant. We owned an apartment complex in a pretty good area, and it was sitting next to a building that building was mostly vacant for 5-6 years.
Yeah,
and it wasn't even poorly located. So I just feel like you probably need to go into it like hotels or any other more speculative with a lot more cash and with knowledge.
So like multifamily, is office space considered Class A, B, and C?
Yeah,
absolutely.
Class A would mainly be newer or in the central business district where office is in really, really high demand. Mm-hmm. B would be more suburban and a little older. And Class C would be, trying to think, 1 or 2 stories, pretty old, maybe 70s type office. So it kind of follows with some of what we talked about on multifamily, and the cap rates are the same. They kind of start lower, maybe 6 cap, 7 cap, and then they kind of move up from there.
Yeah, so I would say a couple things on office. The first one is they're probably a lot more management intensive than some of your other asset classes. You may have a lot more tenants, and the way they do the lease structure is a lot different than most of the other asset classes with modified gross leases. It can be confusing on what it includes and how often it escalates. And the management just bears the burden of a lot more responsibility because there's so many more common spaces to be upkept and kept track of.
Yeah, any of these asset classes that you're going to try to take a look at for yourself, it'd be important to go and talk to people that own those properties in your market. I mean, you could start with the brokers, but owners too, and understand, or maybe the owner has a person that manages their office. That's the guy or girl you need to talk to, because they're going to be able to go over those nuances with you and talk about their experiences. Right.
Yeah, and then the next big thing is when you're going in to buy an office building to look at an investment, you're looking at job growth. You're looking at big employers coming in the area or about to come in the area, rumored to come in the area. You're looking at, corporations that are expanding or growing or might need newer or bigger space, something like that. So, each of these asset classes, you look at different indicators in the market to kind of help you with your underwriting and due diligence. But yeah, office is a massive scale, and there's a lot of it.
Well, hopefully that gave people a little bit of an intro in just the different asset classes. I know when I started, I didn't even know what all you could invest in. So hopefully we gave you just a brief overview.
Yeah, and if you have any questions, feel free to comment, send us a DM message, whatever, email. Our contact information's out there. It's not that hard. Well, I think we wrapped it up. We went over the major asset classes that investors invest in when they think of commercial real estate. Thanks for joining us on episode 5 of How to Invest in Commercial Real Estate. Make sure to check out the website. It's probably the easiest way to listen and watch, howtoinvestinCRE.com. All righty. We'll see you next time.